multifamily crisis or creating massive opportunities. So I was inspired and really just seeing a lot of stuff going on with our clients who have invested in a lot of very well-known real estate syndicators in the apartment multifamily space. One of our mutual friend, Ken McElroy, he did a really cool video with companies, and he, as he said, a crisis is brewing, and I see multiple investments gonna get completely wiped out. And these are supposed to be safe investments, and really deep diving on this piece. The first chart I wanted to pull up here is really the maturity of debt, and that's what's coming due. And really what this is showing here is that there's $957 billion of commercial mortgages maturing in 2025. Multifamily is about 23% of that. And so what this is showing is that what happened is that during COVID and coming out of COVID, a lot of people were buying these multifamily, these apartment complexes, and interest rates were super low. And they did it on bridge financing, interest only, for 2, 3, 4 years. Never in their wildest dreams did they think that interest rates were going to absolutely skyrocket. Well, what's happening now is that if you did interest only and you just did a bridge loan, now that's coming due and you got to refinance. Well, there's two problems here. There's the interest rate shock, that 40% of these maturing loans are at less than 5% interest rate. And right now you're not getting less than 6.5%, kind of probably 7%. 15% are under 4%. So that's crazy, right? That all of these guys now, when they're having to refinancing way higher interest rate expense. The other thing is there's something called DSCR, debt service coverage ratio. This is how banks underwrite the policies. They want to ensure you have enough free cash flow to service your debt. So they look at your free cash flow as a metric of your total debt coverage ratio there. And so originally it was 1.37x, meaning you had $1.37 of income for every dollar of debt. That's now down to 1.07. So there's barely any breathing room here, and most banks want 1.2 to 1.25x dollar or DSCR, which is $120 to $125 for every dollar of debt you're paying. So these two things are converging together. This is creating an issue that I've seen, that a lot of these multifamily apartments are getting given back to the bank because they can't afford them anymore.
I think this is a great example of why diversification is so important.
Yeah.
And in the entrepreneur space, these got really hot because multifamily had this long run where they're making all this, just crushing. And what they were doing, a lot of these multifamily groups, and I know Ken is a lot smarter than a lot of these groups, is they were taking interest-only debt. They were doing a cash-out refi after a few years. All the investors got their money back. They just let the rest roll on, and then they would sell in a few years and make a bunch of money. And everything was working perfectly. So I think the lesson from this, as we're going to get more into this, but I think that the big lesson is diversification. Don't put all your real estate in one type of real estate. Don't put all your money in one type of investment. Diversification is the only free lunch when it comes to things like this. The other thing is stress testing your investments way before there's a problem. It wouldn't have taken a lot of smarts to say, what if interest rates go up a lot? How does this deal look in that scenario, right? And you want to make sure that you can survive through the hard times.
Yeah.
And that's why I think Ken is talking about opportunities that are coming, maybe not quite yet, but that are coming. And I think that's what you need to be aware of. And that also allows you, if you're a smart investor, if you don't over leverage or you don't get over invested in one area, then you can take advantage when something gets overvalued or there's changes in the marketplace that cause that to drop in value, where you can sweep in and get good deals.
Yeah. And before we talk about the opportunity, let's kind of break down. There's 4 variables here that Ken broke down that I thought were great. The first being that floating rate exposure that you talked about. The debt was floating rate. So property owners were reducing their operating expenses. They deferred the maintenance, and now there's some issues with these assets, and that's because of the floating rate debt. They can't afford it. Now they can't keep up their properties. So things are just really deteriorating. The other thing we talked about was DSCR, or debt service coverage ratio deterioration. As Ken said, a lot of the borrowers aren't meeting that debt service coverage test or the debt yield test, so the banks won't even refinance them. So you got to go raise more money. But a lot of people don't want to put money into this asset class right now because they're losing their ass. And then rate cap expiration. We're gonna talk through rate caps and cap rates. And then what he's turning me in this, which I like this, is extend and pretend. Because banks have known there's been an issue here really starting in 2023 when interest rates started really going through the roof. Cap rates expanded, which means the value of these properties is going down while the debt on the interest expense is going up. Those are two things that you don't want to happen at the same time. So banks have been closing their eyes and they've been extending and pretending, just kind of kicking the can down the road a little bit. But that's where, with all of this debt now rolling off, can the banks continue to extend and pretend, or are we going to continue to see an uptick in these properties going back to the banks? And I've seen in the last 3 months, I've seen 3 deals go completely belly up, complete wipeout of all equity from the limited partners.
Yeah, I mean, that's that's what's happening. And we're going to see more of that. I think we're going to see more of that before this market stabilizes. And there's been a lot of hope, I think, for some of these variable rate loans that interest rates are going to come down.
Yeah, yeah.
And I think we can all agree that interest rates have not come down as fast as most people had expected. And anytime you invest in something and you're hoping the government's going to change rates in a dramatic way, that's probably not a good place to be.
Yep. Totally agree. All right. Well, next chart, we've got a historical chart here that goes through and actually breaks down the historical cap rate. And cap rate, for those viewers who are not super familiar, is your net operating income in the numerator, which really is the income or the profit that your company or that the real estate makes before any debt. And then the denominator is going to be really the value, your in-place value of it. So it's a fraction there. And it was 4.5%, which meant that the average property was essentially yielding 4.5% if it was unlevered. That ballooned up to 5.75%. And so since it's you can do some algebra here, and the exit cap rate, you want a lower exit cap rate because that means as you push your NOI up, you divide it by a smaller number that gets you a larger exit multiple there. So cap rates going up from 4.5 to 5.75% means that if that property, if that multifamily property did not do anything to improve their net operating income, so net operating income just stayed where it was, you lost 22% in value by just hanging out where you were. And that's because there's a lot less money flowing into this asset class, and so that's pushed cap rates up. And there's a lot more competition because when interest rates were zero, getting 4.5%, 5.5%, unlevered yield wasn't too bad. But now I can go park it in a money market fund, and the Fed's probably going to cut here soon, but I can get 4% risk free. So why would I want to go, get 4.5 or 5% and invest in a multifamily project when I can get 4% risk free? So cap rates were ballooned up, and this has again created some pressures here on the back end for these developers and these flippers.
Yeah, and your point also about raising money, because these deals, the solution for the syndicator is raise money.
Yeah, plug the hole.
Money would solve the problem.
Yeah, plug the hole.
The problem is people don't want to give more money. And the worst thing to get as an investor is a capital call, not a planned capital call. That's a different thing. If it's a planned capital call, like, okay, we only need this much now as we're building this project. We'll need more in a year. We'll let you know.
Yep.
But it's like, we're in trouble. We need your money. And then as the investor, you got to say, do I want to throw good money after bad? Or is there a chance that this will actually survive? And if I don't put more money in, then I get, watered down in my value. And that's a tough place to be. But for these syndicators, they're really having trouble raising money to try to plug the hole.
Yep. Don't put good money after bad money.
Yep.
All right. Well, we talked about interest rates going up, the cost of debt going up, cap rates going up, which means the value of these properties is going down. Well, the other big variable is net operating income, or NOI. Really, again, kind of like the income from these properties, ignoring any of the cost of debt. Well, NOI was projected to go up and to the right. When you were coming out of COVID, remember, rents were going through the roof. I remember I had one of my rental properties, I think the rent increased by 30%. Now, they locked in for 2 years, so they got me good. But then 30% rent increase when I got new tenants in there, which was just, it's crazy to think about. And at that time, though, these operators in this space thought rents were going to continue to go up to the right forever. So they were modeling 5% year-over-year rent growth forever. But what happened was the exact opposite. So operating expenses started to balloon. You've got operating expenses up 28% in the last 12 months, according to Globe Street. Insurance costs have really gone up in really hot markets like Florida with all of these hurricanes. Insurance costs are through the roof. Texas, insurance costs are going really, really crazy, up 129%, $636 per square foot since 2018. So your expenses would go up. Well, what makes that worse? What about rent growth decelerating? So next chart I got here from CoStar shows the actual year-over-year rent growth. This is pretty recent here as of July 2025. And you can see San Francisco is actually coming back. San Francisco and Chicago, those markets got hammered during COVID. So they're coming back. The AI boom's really helping San Francisco. But if you look at the right-hand side of the chart, Austin, Denver, Phoenix, Tucson, Dallas, Fort Worth, Raleigh, Charlotte, these were some of the hottest markets, the Sun Belt, where everyone was building all these multifamily properties. And now look at negative year-over-year rent growth. So you're not getting the 2, 3, 4, 5% rent growth. You're getting negative rent growth. So not only are interest rates going up, not only are cap rates going up, but also your NOI is going down. Literally nothing is going in the right direction for these guys.
Yeah, and that's where I think there's going to be some opportunities. Now the careful thing you have to be is, when there's all kinds of problems with one class of investments, you have to be careful about which ones you step into and at what time. So I think the key is the operator. You want to make sure that these are people who've done this for a long time, have navigated this, and who haven't done the things that a lot of these operators did, really not out of their own fault, just for a lack of looking of what could go wrong and playing a little bit of defense. I saw a lot of multifamily, pedal to the metal, offense, and no one was thinking about defense.
Yeah.
And sometimes when you have a market that goes on that long, you should think a little bit about defense or what might not go well. So I think there'll be opportunities. I don't think we're quite there, but I think they're coming.
It was the can't lose asset class for a few years there, and now it's the can't win asset class is what it feels like.
Yep.
All right, well, next chart here, lending activity by origination. The government agency is ticking down. This is the Fannie and Freddie. That's the holy grail of financing here. But debt funds now represent 17%. So that dark blue line is inching up. And this is to your point of there's some private debt funds now getting into the space. Again, only 17% of these loan originations, but they're plugging the hole, and they're coming charging a lot higher interest rate. And this is, again, because a lot of the banks have really tightened their belt. They don't want to get involved in this asset class. They've been extending and pretending. And so, loan to value ratios are coming down. I just don't see any relief here coming soon.
No, I agree with you.
There were a lot of people raising preferred equity and mezzanine debt, trying to plug that tranche of equity that was missing because the values were going down and they were having to refinance. And so they were trying to go back to their LPs, like you said, raise more money and then plug that hole, offering 12, 16%, and being preferred in the capital stack. But even after doing a lot of that, I think they've kind of fired that bullet. I don't think there's any more money because now even I saw one that actually went back to the LPs, capital called, did a new tranche of mezzanine debt at 12%. All of that's gone. All the LPs are gone. They're all wiped out. So I think people are learning their lesson here of, like you said, don't put good money after bad money.
Yeah.